So this week, gold suffered its biggest sudden crash since late 2008.
Yeah, it was a bloodbath on the screens.
Right. But here's the wild part. While retail investors were panic selling, just watching their screens in absolute horror, central banks were quietly backing up the truck to buy the exact same asset at over $4,000 an ounce.
Oh, absolutely. The disconnect is just massive right
It
now.
really is. So, welcome to this deep dive. Today is Wednesday, July 1st, 2026. And if you're listening to this, you are probably feeling a serious case of whiplash from the financial news.
Yeah, I mean, you're exactly who we're doing this for. It is a wildly disorienting time to look at a portfolio
Totally.
because we're seeing this huge gap between the screaming headlines and, the actual fundamental movements of wealth happening behind closed doors.
Exactly. And that is the core of our mission today. So, we are looking at a stack of sources sourced directly from the Gold IRA Company's bulletin website.
Great resource, by the way.
Oh, yeah, really incredible stuff.
Hmm.
The anchor for our discussion is this highly detailed market analysis. It's titled Gold and Silver Slide, but Buyers May Be Waiting.
Right.
And we've also pulled a snapshot of the breaking headlines surrounding this chaos just to give us some real-time context. Our goal here is to really demystify this sudden, sharp sell-off in precious metals.
Because it looks terrifying on the surface.
It really does. So we want to give you a shortcut to understanding the mechanics behind these massive price drops. And crucially, why a plummeting chart absolutely does not mean that long-term demand has just vanished.
Yeah, and to do that effectively, we really need to look at who is doing the analysis here.
Right, the author.
Exactly. The author of that main article is Doug Young, and he brings, wow, over 20 years of experience in the financial markets to the table.
That's a lot of screen time.
It is. And that includes spending 16 years as the financial director at World Freight Services Ltd.
Wow. Okay.
Yeah. And on top of that, he has evaluated over 80 different gold IRA companies over the last decade alone.
That's a ton of operational knowledge.
Right. He understands both the macroeconomic theory and the really gritty day-to-day operational reality of these markets. He's a real voice of reason right now.
Okay, let's jump right into the deep end then, the triggers.
Take to it.
If we want to understand the crash, we have to look at what actually pushed the very first domino. So, Doug Young's analysis points directly to macro forces, specifically the US dollar and the Federal Reserve's interest rate expectations.
The big macro levers.
Right. But, okay, let's unpack this, because when people hear, macro forces, their eyes tend to just glaze over immediately.
Sure, it sounds like textbook jargon.
Exactly. Why does a physical metal sitting in a vault care what the US dollar is doing?
Well, it comes down to the mechanics of global exchange. I mean, gold and silver are priced globally in US dollars.
Okay.
So imagine you are an institutional investor in Europe or maybe Asia,
Yeah.
and you're holding euros or yen.
Right, your local currency?
Exactly. If the US dollar suddenly becomes stronger relative to your local currency, well, buying an ounce of gold just became significantly more expensive for you.
Even if the actual price of the gold didn't move a single cent.
Yes, exactly, because your local money doesn't go as far.
So a surging dollar basically acts like a hidden tax on the rest of the world.
That's a great way to put it.
It dampens global demand because it
Yeah.
simply prices those international buyers right out of the market.
Yeah, but it goes even further than that. The second piece of the macro puzzle is interest rates. And this is where the geopolitical headlines in our stack really come into play.
Oh, right. The Reuters piece.
Yeah. We have a Reuters headline reporting that fading U.S.-Iran peace prospects are reinforcing bets that the Fed will hike rates. Or, at least keep them higher for longer.
And real quick, just to be absolutely clear to everyone listening, we are looking strictly at how market algorithms process this geopolitical tension.
Right. Entirely impartial here.
We are not taking any political stance on the events themselves.
No, not at all. But the financial mechanism is this geopolitical tension often sparks fears of supply chain disruptions,
Right.
right? And inflation.
And inflation is the boogeyman.
Exactly. When the market fears inflation, it just assumes the Federal Reserve will keep interest rates high to fight it off.
And when rates stay high, Treasury yields go up.
Correct.
Which brings me to an analogy for how investors actually view this.
Let's hear it.
Okay. Think of holding physical gold, like owning a beautiful, pristine piece of land out in the country. It's valuable, it's a great hedge, and it is entirely yours.
Sounds nice.
Right. But that land does not generate a monthly rent check. Now, imagine the bank represented here by U.S. Treasury yields suddenly calls you up and offers to pay you massive guaranteed risk-free interest just to hold your cash in a savings account instead.
Wow, okay.
Suddenly, the opportunity cost of holding that non-yielding piece of land goes way, way up.
What's fascinating here is that captures the hypersensitivity of gold to these macro environments perfectly.
Because it doesn't yield anything.
Yeah. Right. Gold does pay a dividend. So when bond yields spike, traders calculate that holding gold literally costs them the opportunity to make, say, a guaranteed 5% elsewhere.
So they just dump the gold.
They dump the gold to chase the yield. And this dynamic is exactly what leads to the other headline in our stack from CNBC, noting that gold is facing its biggest monthly drop since late 2008.
I really want to pause on that 2008 reference because that historical context is just critical.
Oh, it absolutely is.
In late 2008, the entire global financial system was actively melting down. Gold plummeted nearly 30% during that specific window. But people weren't selling gold because they thought gold was suddenly worthless, right?
No, not at all. They sold it because it was a liquidity crisis.
They needed cash.
Desperately. In
Yes.
2008, massive institutions were facing margin calls on their toxic real estate assets. They needed U.S. dollars immediately just to survive.
Right.
And gold was one of the only highly liquid assets they could actually sell to raise that cash quickly.
So they threw the baby out with the bathwater.
Exactly. What Doug Young is pointing out is that we were seeing a very similar reflex today. The initial drop is driven by the immediate mathematical reality of higher yields and a stronger dollar.
Okay, so the strong dollar and high interest rates explain the why of the initial drop, but I am still really hung up on the sheer brutal speed of it.
It was fast.
Too fast. A shift in opportunity cost explains like a gradual reallocation of a portfolio. It does not explain a violent overnight cliff dive. Why did it happen so incredibly fast?
And that is the critical pivot from the macro triggers to the market accelerators. Doug Young dives really deeply into the underlying structure of the market to explain this.
Okay, what's under the hood?
He focuses on two concepts that really dictate modern finance: leverage and forced liquidations.
Okay, let's define those for the listener because leverage gets thrown around a lot. We are basically talking about using borrowed money to amplify your trading position.
Yes. So in the paper markets, these are the futures contracts where people trade the promise of goals rather than the physical metal itself. You don't have to put up the full amount of cash.
Right, you're trading paper.
Yeah, you might put down like $10 to control $100 worth of paper gold. That is leverage.
Sounds great on the way up.
Oh, when the price goes up, your profits are supercharged. Yeah. But your margin for error is, well, virtually non-existent.
It's like carrying a massive tray of full water glasses on a remarkably bumpy train.
That's a good visual.
You're holding way more water than you could ever carry in your own two hands, which is great if the ride is totally smooth. But one tiny jolt, just one small drop in the price, and you lose your balance. The whole tray spills.
And that spill is the forced liquidation. And the crazy part is it's completely automated.
Wait, robots are doing this?
Pretty much. Traders rely on what are called technical support levels. You can think of a support level as a psychological floor on a price chart where buyers have historically stepped in to defend the price.
Okay, so a safety net.
Kind of. But when the macro forces push the price down just a fraction below that floor, it triggers an absolute cascade. Automated trend-following algorithms just wake up.
Wow.
The computers see the floor break, and they ruthlessly execute sell orders to exit those leverage positions before the borrowed money is wiped out entirely.
So it becomes a feedback loop. The initial selling drops the price further, which breaks the next support level, which triggers more algorithms, which drops the price even faster.
It is a violent flushing out of heavily crowded trades.
Yeah.
The algorithms, they aren't looking at the geopolitical landscape or the intrinsic value of a precious metal.
They just see the math.
They're just executing math based entirely on momentum.
But I have to push back here on behalf of a regular person trying to make sense of this.
Sure. Go ahead.
If the paper market moves in milliseconds and algorithms can just dump billions of dollars of paper gold in a single afternoon just to cover bad bets, why should I care about the intrinsic value?
I hear you.
I mean, the paper market dictates the price on my screen today. If algorithms control the daily reality, isn't the market fundamentally broken? Doesn't this mean I'm just holding an asset that can be artificially crushed at literally any moment?
It is entirely rational to feel that way when you're just watching the screen bleed red all day. But consider the alternative perspective that Doug Young outlines.
Okay, what is it?
What you are witnessing is not a broken market. It is a temporary clearing mechanism. The paper market is essentially the tail wagging the dog.
The tail wagging the dog. I like that.
Yeah, the steep algorithmic drop in price tells you everything about the fragile structure of speculative trading, but it tells you absolutely nothing about the underlying case for holding precious metals.
So the asset itself is fine.
Exactly. The fast money gets fleshed out, but the fundamental reality of the asset hasn't changed an iota.
Which actually brings us to the most fascinating contradiction in our source material, the floor.
Yes, the floor.
Because if algorithms are ruthlessly dumping billions of dollars in paper gold, someone has to be brave enough to stand on the other side of that trade and catch the falling knife.
And they absolutely are. This is the stabilizing force Doug Young talks about: patient capital and physical demand.
Let's look at that FX Empire headline we pulled. It reports that gold is defending a double bottom at a staggering $4,024.
Yeah, $4,024. It's huge.
And for those who aren't reading charts all day, a double bottom is a technical pattern. It happens when the price hits a low, bounces up, falls back to that exact same low again, and outright refuses to drop a single penny further.
It's a wall.
Yeah, it tells us there is a massive, impenetrable wall of buyers parked at that specific price. And the fact that this floor is sitting at $4,024 is staggering, considering that just a few years ago, $2,000 was viewed as a historic ceiling.
That new floor exists because the buyers stepping in right now are not day traders playing with leverage.
Who are they?
They are buyers looking for actual physical delivery. We're talking about massive institutions building long-term allocations and, more importantly, central banks.
Which lines up perfectly with the CNN headline in our stack. Quote, "Central banks think the U.S. has become riskier. They plan to sell dollars and buy gold."
There it is.
But I want to know how they are doing this. If central banks and physical buyers are scooping this up because, as Doug Young says, gold is no one's liability, why doesn't that massive physical buying immediately overpower the paper sell-off?
If we connect this to the bigger picture, it comes down to the vast difference of velocity between paper and physical markets.
The speed again?
Right. We established that paper derivatives move in milliseconds. Physical accumulation operates on a timeline of months and years. Central banks do not just log on to a brokerage app and smash a buy button for 50 tons of gold.
Because that would blow up the price.
Exactly. If they did, they would instantly spike the price and completely ruin their own purchasing power.
So they use stealth.
They use over-the-counter markets. They sign direct private contracts with massive refiners in Switzerland. They execute sovereign-to-sovereign transfers. They quietly and methodically absorb the excess supply over time.
Wow.
So you end up with this bizarre reality where paper market weakness and physical buying exist in the exact same moment.
That's wild.
The algorithmic fast money drives the daily ticker down, while the patient capital of central banks uses that artificially low price as a discount window to just empty the physical vaults.
It's a clearance sale for countries.
Exactly. Doug Young highlights this beautifully. They're buying gold because it is, quote, no one's liability. It doesn't rely on a government promise to maintain its core value.
It is incredible to think about these two entirely different games being played simultaneously on the exact same board.
It really is.
But we need to shift gears and talk about the sibling rivalry here. Everything we've discussed applies to both metals, but if you look under the hood of this recent slide, silver is behaving with far, far more volatility than gold.
Silver is wild.
It really is. It's throwing a massive tantrum.
Yeah.
Why the divergence?
Well, silver operates with a very complex split personality. Gold is almost exclusively a monetary and reserve asset. As we discussed, it's a store of value, a hedge against systemic risk.
Right.
Silver is also a monetary asset, but it is heavily, heavily tethered to industrial demand.
And we see that in the USA Today headline from our stack. Silver hit $100. Was AI really the reason?
AI is everywhere.
I have to admit, when I first read that, I was highly skeptical. Is artificial intelligence really moving the needle on a global commodity, or is that just headline hype to get clicks?
Oh, it is absolutely moving the needle.
Yeah.
Because the physical reality of AI is incredibly resource intensive. Data centers require massive, massive amounts of electricity and highly specialized hardware.
Right.
And silver just happens to be the most electrically conductive metal on Earth. It is irreplaceable in the high-end switches, the relays, and the cooling systems required for these servers, not to mention the millions of solar panels being built to power these data centers.
Okay, here's where it gets really interesting. Think of silver like an actor who splits their career between two completely different worlds.
Oh, I like this.
On one hand, they do these serious, steady indie dramas. That represents silver's monetary value. It's a trusted historical store of wealth. But then on the other hand, this same actor stars in these highly volatile, massively budgeted summer blockbusters.
The AI boom.
Exactly. That's the industrial and tech demand. So when economic growth concerns arise, silver gets pulled in two directions at once.
Yes, that duality perfectly explains the violent price swings. When the macro environment gets fearful, silver takes a hit from the monetary side because of the strong dollar and high yields we discussed earlier.
The indie drama funding dries up.
Right, but it takes a second unique hit because investors fear a recession will slow down the AI boom. If tech companies build fewer servers and factories manufacture fewer solar panels, the industrial demand for silver drops.
It takes a punch to the jaw from the bond market and a punch to the gut from the factory floor.
Exactly. And here is the fundamental constraint that makes silver so volatile. You cannot easily spin up more silver production to meet sudden demand.
Why not? Just dig more.
Because most silver is mined as a byproduct of copper, zinc, or lead mining. You don't just open a silver mine because AI needs it.
Oh, wow. I didn't know that.
Yeah, so the supply is highly inelastic. When paper traders panic and dump silver, it crashes hard. But when the tech sector actually needs to take physical delivery for manufacturing, the underlying supply simply isn't there to meet a surge, which creates these massive explosive rebounds.
Okay, we have covered a massive amount of ground here. We've gone from global currency exchanges to high-frequency algorithms all the way down to the electrical switches inside AI data center.
We really ran the gamut.
We did. So as we synthesize all of this, what is the ultimate actionable takeaway for you, the listener? What Doug Young's analysis really reveals is a relentless tug of war.
That's the perfect way to summarize it. On one side of the rope, you have the fast money, the leveraged speculators and algorithms reacting violently to daily fluctuations in Treasury yields and the U.S. dollar.
They are forced to sell when the math turns against them.
Right. And on the other side of the rope, you have patient capital, central banks, institutions, and savvy individuals who look past the daily ticker. They view algorithmic panic as a clearance sale, quietly accumulating physical assets for long-term security.
So how should our listener actually apply this framework tomorrow morning when they open their newsfeed and see a scary headline about a market crash?
You apply it by changing the metrics you pay attention to. The next time you see a headline screaming that precious metals are plummeting, do not just stare at the price ticker. Look at the variables driving the algorithms.
What should they look for?
Pull up the U.S. dollar index, the DXY. Look at the 10-year Treasury yield. If those are spiking, you know exactly what is happening. Macro algorithms are simply doing their job, executing trades based on yield math.
It's not a fundamental failure of the asset itself.
Precisely. By understanding the mechanics of forced liquidations, you can recognize a temporary flushout for what it is, rather than panicking alongside the fast money.
It is about checking the foundation of the house rather than panicking every single time it rains outside.
The weather will always fluctuate, but the foundation dictates whether the house stands. Which actually leads to a terrifying hypothetical that I think anyone tracking these markets needs to deeply consider.
Uh-oh. That sounds ominous. Where does this all lead?
Well, we have clearly established that physical buyers, particularly massive sovereign entities, are quietly and continuously draining the vaults of physical gold.
Right, the central banks are backing up the truck.
Simultaneously, paper traders are using leverage to continuously drive the daily price down. The lingering question is, what happens to this entire financial structure on the day the physical supply actually dries up entirely?
Oh, wow.
If the paper derivatives keep artificially suppressing the price, while the real-world vaults are quietly emptied by patient capital, the tension has to break.
Something's got to give.
What does the global market look like on the day the paper promises outnumber the actual physical ounces by 1,000 to 1, and a major institution finally demands physical delivery, only to find the vault is empty?
Now, that is a structural breaking point that will absolutely keep you up at night, and it perfectly circles back to why we do these deep dives.
Exactly.
The financial landscape is not a clean, predictable chart. It's murky. It's filled with hidden leverage, competing timelines, and a high-stakes tug-of-war between the digital screen and the physical vault.
It's a complex machine.
It really is. So if you want to understand more about how to navigate that vault and really dig deeper into the incredible research and market analysis we unpacked today, you need to check out our source material.
Highly recommend it.
We highly recommend that you go to the Gold IRA Companies Bulletin website at goldiracompaniescompared.com for a wealth of related information. I'll spell that out so you have it. That is Gold IRA, companiescompared.com. And we want to explicitly inform you that there's a link to this information right in the episode notes, so you can easily find it.
It truly is an invaluable resource for cutting through the daily noise and focusing on the underlying mechanics of wealth.
So until next time, keep your eyes on the foundation. Don't let the algorithms shake your tray of water glasses. And thanks for taking this deep dive with us.